Right, so do you guys remember when, I'm pretty certain we actually spoke about it. I'm pretty certain that we spoke about it in the last session. In the last session, I think. And it was about the market opening up on Monday, pushing one direction, and then continuing the next day, and then reversing. Right?
Yeah.
So you can see clearly here, just alter this. So you can see, right, the market basically flushed out all of the liquidity on Friday, right? But this was the last point of liquidity here. Price trapped all the way up until New York. Price rocketed up, and then it broke lower, right? So what that signifies to us is obviously the continuation of the structural expectation that we're likely going to continue lower. The other thing is, once all of that liquidity has been taken to the left, it's exactly the same as a move being made, right? The cycle resets and we start fresh. So then look at what happened here, right? At the low during Friday, 5 p.m., 6 p.m. was actually the low of the week. Price didn't create any liquidity, there's nothing there whatsoever, and it just stalled kind of mid-move. Had a tiny little gap up, then price pushed higher, broke lower, pulled back, mitigated, broke lower again. Okay, now we've started to trap sellers. Bang, that was that move yesterday, beautiful push up, fake reaction of the SMT, took the smart money traders out. It obviously tapped into whatever happened here in New York, left some equal highs, price pushed away again, filled the last imbalance to continue higher, right? So what the market did was basically mainly trap buyers, but we trapped sellers in the process as well, right? So yes, the structural expectation, like this is why it's so important. When this low got made, the structural expectation has been confirmed bearish again, but before we actually go bearish, we obviously need to build some liquidity and take it, send people the wrong way, and then continue going in the right direction. Make sense?
Mm-hmm.
Right. So now, like this is exactly what I said. Remember, I think we mentioned that Thursday. Was it Thursday? No, sorry. I think it was on Saturday. That was my bad. Because I was wondering, how did we talk about this on Thursday? That was Friday. Yeah. So this was on Saturday, right? So remember this, what I mentioned about the news move and about making the wick. I can't remember what I actually did to make it disappear, but I think I did. I don't know what I did. There we go. Yes. Right? You see that? That wick has now been removed. Price gave a fake reaction. Right? Let me change that. I'm going to have to change that one now. Price gave a fake reaction here. Right? During New York. And then price gave another fake reaction the following day during Asia. It never took that wick. Have you noticed?
Yeah.
Never took that wick. Do you know why? Because it's not real. This is what I was trying to explain about the news move. You got to understand, like, this one thing that I learned this maybe like a year and a half ago. I never even knew that was a thing. I always got confused. I was like, what is this wick done? Wait, is that the high? Is that the low? What's even? And then you realize that wick's not real. And then if we, where is it? Put it back on again. And remove it. Price never has to go above. Obviously, there was no move here, but that was just, you know, the point I was trying to make. That price completely removes that wick out of the equation, and you got to go off the structure which has actually been created, which was here. All right. Again, not really any ideal moves after the news, but it is what it is, right? Anyway, so going back to script, so the market will do this, and as you evolve, you next year and next year and next year, you'll notice that when the market opens, it will push one way, and if it pushes the same way the next day, now it's basically telling us, hey, the intention's there, right? We know we're super duper bearish, right? That's just there. Look at that. Why in the world would we reverse there? And there's no liquidity above. So the market's reset. So this is when you have this foundation, when you understand, hey, where is the market? What part of the cycle is the market in? Is it building liquidity? Is it trapping? Is it ranging? Or is it impulsively trading like right now? Here, that's why I'm saying there's no interest of anything there, because technically the move's already been made, because all of that liquidity got generated prior, and then the market reversed against it. So what the point of all that is that when you do notice the market open, push one way, and then push again in the same direction the next day, then you got to look for clues. It doesn't automatically mean, oh, Carol said, you know, Monday pushed one way, Tuesday pushed one way, so that means, you know, there's a selling coming. That's not correct. What we want to do is just basically put the pieces together and understand what is actually being presented to us in real time, right? Even if I said to you, yeah, on a Tuesday or a Wednesday is usually when the high of the week is made, that is accurate to a certain degree, but again, it's just data. It's not guaranteed. It happens every now and again. But in this scenario, look, the market peaked at Tuesday 5 a.m. during Asia when everyone was still asleep. And then look, no entry whatsoever. They reversed their positions. Bang. Right? Here, when they looked at the market as well, right? Did anyone, by the way, obviously this was the last inducement, did any of you guys think that that may have been an inducement low?
Thought it was when I was looking at it this morning, because it would have took that last low. And it was rushing down with speed.
Yep, that's partially correct, but what's the structural expectation?
Ish.
And where's most of the liquidity? Which way is it being trapped?
Downside.
Say again?
The sellers are getting trapped.
It's mostly buyers, remember?
Well, buyers the day before, yeah.
Yeah. So sorry, what I mean is in since the market opened. Yeah. So early on, I used to make this mistake a lot. Like I used to just like assume and be like, right, well obviously the market's trending one way and it's trading against the next day and it technically took that structure, so it must be bullish now. No. The liquidity is bullish, but the overall structure is bearish. Now until, right, at what point do we confirm the structural expectation is shifted?
If we break the previous high.
Okay. How many times?
2 times.
Is it twice?
Exactly. Right? Which means that we would need this to occur, which technically that was the first structural shift. But then what we'd need is price to basically pull away, play out, whatever, and then maybe the same day, the next day, rock it up again. Right? It's the exact same thing when we explain to you about breakout traders, for example. If we're trending one way, breaking out, and then all of a sudden you have a breakout the opposite way, there is no confirmation whatsoever that that's a reversal or that we're shifting. It's just taking recent structure, maybe taking recent liquidity. However, if that then pulls back but fails to continue making a new low and then continues to make highs now you've got a second confirmation, now you've got momentum, the money is shifting. Okay? So that's what we're going to pay attention to. So in this scenario, the reason why some of us would have thought that this was an inducement, because we had obviously speed and momentum. But has the market left any liquidity there?
No.
No.
Therefore, the market's saying, hey, we're likely continuing lower. Right? So this is why we use this little thing, right? This little box that we just use our keyboard on is incredible, because 9 times out of 10, the trades that you take are going to be in line with the structural expectation, because most of the time there's a flow of which way the market's moving, right? You're not going to intentionally keep looking for counter trends to try and catch the top or the bottom of the market, because then you're going to get caught out. The trend is your friend, right? We're not trend line traders, but we use the overall trend to our advantage to find these setups within the liquidity, right? So like I said, in this scenario, we wrote down structure expectation is bearish, liquidity is buy side. Has there been an inducement? Well, technically it's induced last week's Friday's high. So you can say it was an inducement, but was there an entry? Was there a real breaker structure? Was there mitigation? No. Therefore, no valid setup, right? So what the market did is trap all these buyers and they just take them out and continue lower. That's it. End of story. So for future reference, always pay attention to the structural expectation, to which way the market is beginning to trap. If we're bearish, but we're trapping bullish, you see where I'm getting at? If we're bearish, but we're trapping bullish, market's likely going to go bearish. Make sense?
Yeah.
That's it. So when you understand these depths of how liquidity works, that's how to the average Joe, you look like a wizard, because nothing what they're looking at makes sense. And we understand precisely what is happening, right? So, any questions in regards to what I've just explained here? Or is it as crystal clear as a platinum diamond? If that's a thing. Okay.
Now you've clarified more for me regarding like inducements.
Yep, good.
Like, makes more sense how it's not an inducement, because it is in line with structural expectation.
Mm-hmm. And you see how it continues to trap here.
Mm-hmm.
Right? Look at when obviously when we look at it, it makes so much sense because there's nothing random. So how it does this, let me just take this arrow off. How it takes with speed, breaks internal structure, pulls back, breaks internal structure again, but there's nothing above. Literally nothing at all, not a single bit of. There you go, the perfect example of what I said about breaker trades. No one would be selling there, because think about it. For 2 days straight, the market's opened and it's making higher highs and higher lows, and it has one little internal breakout. You think people are going to be like, oh my God, it's reversing. Nope. because it's an internal structure. Why in the world would anyone be selling there, right? This is fabricated on purpose. It's made this way so you don't get in. It's so they just mitigate their positions and don't give you any entries. And then when you look at this now, look at what it does here. Look at sneaky little thing here. What time was that? So technically this was on actual New York Open. Like it literally presented the opportunity right there. Look at that. Boom. Perfect POI. Is this the weekly low? Friday, let's have a look. Friday, Monday, Wednesday, Tuesday. Yeah, that was the weekly low, right? So this is something we've not really gone in depth into, but it's definitely something that we can add a bit more fuel to the fire in a way. You don't have to annotate every single previous daily high or low or weekly high and low, but you can annotate the closest ones that could potentially make sense, right? So by this point here, when we get to this area there, look how close that previous weekly low is. Like, let's look at weekly. See that? There's a weekly low. Obviously, when price is like mid-candle up here trading something, we're not interested in that low because it's way too far away. Same with the high. The weekly high is way too far away, so we just maybe take note, have some awareness, but we don't need to concentrate on it unless it gets too very closely, right? So if we mark this up as the previous weekly low, right? Just start from the beginning how we did before. Market closes, market opens, highs, lows, right? We only have buyers trapped. We probably have swing traders, whatever types of traders trapped. That's the previous weekly low, which has been untapped after a massive news move up, which reversed it, then the market closed, right? So by this point, I would say by this point, when price started to break this SMT, people probably entering longer positions, putting their stop losses below here and here, right? So look at how the market took that inducement low from Monday, gave a reaction, came back, break it down to 5 minute, gave a mini little reaction, went a bit deeper, then broke out, took it, come back, filled the POI to melt lower. Right? So you could have potentially targeted, if the risk reward makes sense, the previous weekly low, because the market has got no reason to go up here whatsoever, not even a tiny bit. And the other thing is, if the market did react and do that, and then do that, that is setting up for an even better setup to target. Do you understand? So instead of it doing that and breaking out again, because obviously if we have a reaction, a pullback, they have a mitigation, and it actually breaks out, think about how many more orders are being filled, how many more entries are being triggered, and how many stop losses are now being put underneath this this zone, right? And again, if we think about this logically, right, we always look to the left. If price, let's draw this again. If price did react, pull back, and then break out, we immediately know the stop loss is there. And then if it were to keep pushing and pushing and pushing, is there anything to the left anywhere here whatsoever that price needs to mitigate?
No.
No.
There's no clear POI, anything whatsoever, is there?
No.
Nothing.
Which means that if we started to do that, so something like that, for example, right, where it's creating order flow, it's basically saying, I'm running out of steam now, I'm coming to get that liquidity. Because where is the only piece of liquidity in the market right now?
Below.
That's it. Literally there, right? Very obvious, we know that. But we can only know that if we put all the pieces together, right? We can't just, remember, just because there is speed and momentum, you can't immediately assume, oh, well, this is an inducement. Does it make sense for it to be an inducement, or is it a trap? That's what you ask yourself. Okay, well, structural expectations bearish. There's no liquidity above. Okay, let's see what the market does here. Okay, we have a reaction. We pull back. We have another shit reaction. We have a better reaction, break a structure up. Look at this. This is exactly how this works. It will give you a fake little reaction, trap a couple of sellers, go a little bit deeper. Break structure again with a bit more speed. And as soon as it does it, bam, breaks lower again. Continuing structural expectation. Pull back mitigation. And they got boom. There's order flow. Now, as soon as you see this, I obviously have to mark up the POI correctly as well. As soon as you see the rejection, comes back up, fails to continue, bang, internal break, comes back again. Look at this. If you're looking between the lines, right? So have a little POI here. Respecting order flow, right? With a rejection, boom. Struggles to break higher, breaks lower again. Comes back up, breaks lower again. Look at this. Oopsie daisy. On the bearish should go for it immediately. Again, fails to break higher, fails to break higher. Look at that. It's like a slide. Woo! That's that. Right? So, it's there. It's there. And it makes sense. I'm just showing you this for future reference. Why we always want to take trades in a line with structural expectation. If we do get it in the opposite direction and it makes sense because it's fresh liquidity, then we take it, we go for it, obviously. We have to do that because the money is going to the downside, not to the upside, right? Trust me, I learned that the hard way. I would always say, well, there's an inducement there, and then they'd be like, yeah, but the inducement, I went with my own thoughts instead of focusing, oh, well, which way is the market inducing? Oh, it's inducing up. Oh, yeah, but what if it continues going high? And then I just do dumb shit like that, and then they just get caught out, and I'm like, obviously that was an inducement. It'll always trade away from it. Why would I trade in the same direction of it? It makes no sense whatsoever. So, yeah, but you got to get stung. This is why... this is why you got to understand that the market has to burn you enough times first. You have to feel that pain and suffering, and then you'll stop doing it. Or you'll continue doing it until you actually go insane, and then maybe you'll stop. Right? So it's something for you to chew on, to remember. And also, mindset-wise, just always remember that every single loss that you take is an expense. It's not taking your soul. It's not actually taking your money. You're technically giving the money, you're borrowing it to the market, because over a longer period of time, the market's going to give you that money back plus multiples, dividends on top of that. Right? So don't worry about losing in the market or having losing streaks, because it's inevitable when you're in the learning process. Right? So, a lot of, hopefully there's a lot of detail there that was mentioned for you. Right, so like we said, so there's not really anything on GU. There's obviously, what time was that? So yeah, so like I said, so because the time shifted right now, that was technically on New York Open. But that's a bit more of an advanced one, because it's, you know, like we said, some of us thought that this was the inducement, so it would have easily, you know, confused us. So let's have a look at some other stuff. Euro's basically exactly the same. There's nothing. Yeah, same here. Look, it's literally done the exact same thing. You can say that it swept that all of that range from, was it Friday? Monday. Oh, sorry, this was Monday, right? There's Friday was here. Right, so yeah, so Monday, look, lefties equal lows, price pushed away, never liquidated anything, market closed, again pushed higher, trap, and it just started a mess here, sending people one way, sending the wrong way, and then same here, look, on GU obviously it was a bit more of a massacre, but here, look, it literally did, you could call that an inducement, but wasn't even, there's no mitigation, there's nothing, it just dropped lower. It did a magical head and shoulders, look at that, oh. I can't remember the last time I've seen that pattern before. It's been a while. Back in the day, this is as soon as you get that rejection, you get the stop loss above there, and you get paid out. Look how simple that is. Imagine it was that easy to be like, oh, there's that mountain top. Yeah, that's the one. As soon as it rejects, I'm selling. And obviously, those traders have to get paid out every now and again, because if they never got paid out, then those patterns wouldn't even be on the internet. It's a trap. It's always been a trap. But you don't know it until you know it. You don't know what you don't know. Okay, let's check AUD. Market open here. Look at the gap that hit this left. Yeah, it's a bit of when we back tested it and looked at a few of the days, it was actually doing decent stuff, and then here it's just it's not really doing much. So we'll leave that one. Yeah, I thought that it would continue higher. So look, from the moment that we took this low, we dropped another 1,200 pips. And the reason why I took those buys there is because look at price all the way down. What do you notice? What are we missing? From the moment this made that fake breaker structure higher all the way down, what do we not have?
We need more liquidity to go lower.
Mm-hmm.
So that's the reason why you take probably trade up more. I mean, the buy trade.
Okay, but what I mean is here. See this entire leg from from the high.
Yeah.
What are we
Trend
missing
line.
here? No, what are we missing here? What is not there? It's a very simple question. Maybe I'm not phrasing it correct. There's no pullback anywhere. Right? That was one leg down. Now we've had a pullback. Right? So if the market impulsively just keeps selling off, and not giving people entries, that's because it's happening intentionally. It's not by accident. This is why when I broke it down to the lower time frame and noticed that we did have some sort of reaction, but at this point you have no idea what's gonna go on here. Then we break higher, and then we break lower. So that's why I look to go short here earlier to target the structure low. But then what started to happen is it started to fail to break lower, right? It never broke this low to confirm the RBOS and the mitigation to continue. We failed twice. And after the second time it failed, look, we had an internal breaker structure back up the SMT. At this point, I knew that's an SMT. We're faking, trapping more sellers to continue lower because we've already come down impulsively. Bang, pushes up with speed against the POI. Obviously, we don't want to be seeing price going with, look at that, multiple vector candles. We don't want to see vector candles into the POI, ideally. We want to see him away from the POI, right? So as soon as we had that internal break, price pulled back, and immediately continued those vector candles, bang, entered stop loss below. I initially I initially targeted this high here, because that was the last structure left. But again, this is another reason why I took partials and I ended up closing up here, was because same here, price never pulled back, right? I've got no reference. Price can literally go up and then straight back down again. It's got nothing to use, no imbalances to fill, technically to use as support to continue going higher. So I had to be mindful because I'm trading against the structural expectation, right? This is what we've got to understand to the depths. You need to understand what type of trade you're getting yourself into. If you're getting into a trade where probability is on your side because you're in alignment with the structural expectation, then it's more than likely going to play out if that's the real move. If you're trading the opposite way, you need to be watching it, especially gold. Fucking hell, you need to be babysitting it, right? You need to be mindful of what you're getting yourself into. When I saw this and I saw this little reaction, I thought, this is probably just break and retest, maybe have some sort of reaction. I actually felt it intuitively that this is likely to go a bit higher. It pushed a bit higher up with more speed and momentum. Look at these last candle, wham. And as soon as it started to reject, I was like, I'm out. Why? Because I'm going against the flow of the market. I have no idea if it's going to go there, if it was just going to stop here. This was more just intuition, so I just took the risk. But then as soon as it started to push up with no pullback, I was out, right? You have no idea if it's going to go there, if it's going to go there, it's going to go all the way back up to fucking Asia. We don't actually care. We just need to understand that it's got plus 4R, no drawdown, trading out of timing. I'm walking eggshells there. So I need to be mindful of this shit, right? And the same goes for you, right? I could have, in the course, I could have easily just presented you with 10 different entries and blown your fucking mind. And you probably, even to this point, you'd be confused and asking, oh, well, this, and this. We didn't want to do that. We wanted to simplify everything as much as we could into 2 entries, right? And those 2 entries work so well. Why in the world would you need to take 10 types of different entries. Obviously, with experience, this will come naturally to you. You'll just feel what the market is doing and how it's behaving, and you'll feel more confident in taking those entries. But you don't want to overwhelm yourself. So obviously, some of the trades that I posted in the community trades, you know, some of you guys may not understand it fully, but that's okay. You will over time. But I'm just showing you what's also out there, right? But yeah, look, either way, the initial target, which I put the TP, it has now been hit. But what did price do? It would have came and stopped me out, and then it would have continued. But if I'm entering here, and then price rockets up like that, I have no idea if that shit's going to continue coming lower, or it's going to do whatever it's going to do, right? The only clue that I actually had, obviously I was already out at that point anyway, but the only clue that I had that this would from this point would likely continue going higher, was that here we had another trap, exactly same. Just put it down on a lower time frame. See this SMT? He just did it on a wider range. Let me just remove this. Put this here. It's just done the exact same thing. Look, it actually broke structure away. Very obvious that there is stops above. Right, it failed once. Now it's done a wider, so now it's attracted more traders. It's actually broken structure fully this time. And then as soon, look at this. There's actually another setup right there. Look at what he's done. Bang. Right? Think about this. This is how technical it can get sometimes. When price arrived here and did the R-boss, did it take liquidity or not?
No.
No. Well, obviously we know because obviously the chart's there. But that, look what their stops are there. At least there or above. Like, let's just put it here just for precision's sake, right? That's a fake reaction. Look what price does. It just reacts and then it messes. What this is doing is it's making the sellers shit their pants before it stops them out, comes back, fills the gap. Look at that. Comes back perfectly, fills the last imbalance, and then continues going higher. Look at the size of that imbalance. 3 minutes looks better, I think. Yeah. So there you go. It's just done the same thing twice in one day. But it's harder to trade the second one because the entry doesn't actually really come until after the SMTs have been taken out. So how in the world do you know if it's going to continue going higher? Or just assuming the momentum of today because there's nothing else to go off, right? So we're getting quite technical here. I don't want to burn your brain cells because it goes deep. It goes deep, y'all. It goes deep, right? But yeah, here, look at this. When we had this significant break of structure low, as soon as it did it, had a little reaction, pull back, bang. As soon as it starts to push away again, that's the risk entry there. Straight into their stops. And look at that instant as a technical, that's New York Prime. Now look, open, bang, no, literally more than no bottom wick, straight to TP. Yeah, gold is a different breed. You got to get used to trading that. But yeah, this is something that I wouldn't recommend because you're going against, again, natural flow of the market. But the clues are there. If it's leaving an SMT there, breaking higher. Nothing to make it, even this now, if I'm looking at this now, that's just another larger time frame SMT. So if now I'm looking at this as a larger picture, technically the stops are there. And then this is the RBOS. And that's the POI. So now when you look at it from a bigger time frame, it makes even more sense why it's continued going higher. Because if we remove that, then it's like, why would it continue going higher? Well, there's a bigger time frame SMT. Look, all it did was trap sellers all day after London opened. Inducement low, mitigation, continuation. Quavy stuff. And then now, all the sellers that have been trapped have been liquidated. There's nobody left. Where's the market going to go? Well, now we don't know. Because it can do whatever it wants. But since we are so bearish, we may continue lower. Because now we've had 1 break, 2 break. Now we're beginning trap buyers. It just never ends. It never ends. The what's that big wheel called? The Ferris wheel. The Ferris wheel never stops. It's 360. Well, technically, it's not 365 days because if we take out the weekends, it's probably a lot less. Probably like 280 days a year. It just doesn't stop. Builds liquidity, takes it. Builds liquidity, take it. Now, if I said to you, go on your chart to the early 2000s, go into the early 1990s and look at how the charts behave, do you think anything has changed? No. Nothing's changed. The markets have evolved a little bit because we've got the foundation of obviously smart money, which I personally did trade as well for like a good 2 years. About 2 years, yeah. But then when you realize this level of trading, nothing needs to change. Nothing needs to change. But the beautiful part about it all is once you have the understanding of inducements, you literally got an edge above most other traders. In fact, all of them. All the other retail traders. Other than the obviously whales who just control the market with their billion-dollar lot sizes. Well, yeah, looking at this, look, if we react from this, this is what I mean. The timing's a bit confusing now. Let's go back to here. Okay, just to cover the imbalance, really. So right now, if I said to you, is this another SMT or could this be a POI? What would your answer be?
It's a break structure lower for it to confirm it as an SMT.
Or a significant, or just a significant reaction. Even if it did something like that, and it bounced off here, and then it came back up again. Then if we can get if we have a big zone like this and we get a reaction of like I mean, 200 pips, right? It's not random. There's obviously money being pumped there. But the reason why I asked is because that was a smaller time frame, FBOS up to continue going lower. All right. Now price, what's happened is we have technically had another FBOS lower here and then pushed in to that region. But because of what time it is and where we are in the market, it's just not worth it. Because think of how obvious now that is. Massive demand, price pulls back, comes all the way to the demand. See how more visible it is to most traders? So people will just be like, oh, this is it. This is the one. It's going to continue lower because it's bearish. So, but why would it continue lower here? It would likely give a reaction, take them, and then go. Because then it's got more momentum. As we're here, this is what I mean. It's just so funny. You can get easily confused. Market could just do that. But if it does do that, then it does that. But if it gives off a fake reaction and then it pushes up with speed, now that gives us a bit more probability because, hey, we have trapped buyers all day here. We've got an FBOS and a fake reaction off the SMT. Continuation high of speed. Structure expectations bearish. There's nothing to the left to take. Hey, this could do some shit like that. But I don't know. It may have already exhausted traders out for today. So there's not much that we can confirm there. But yeah, from what we've broken down here, does everything make sense? Is there any questions? The more questions, the better. Anything that you're uncertain about, unsure about? No, I'm good. Hopefully I've not put you to sleep. Hopefully your brain is still actively working. Yeah, there's nothing. Look at that. What is this stuff? What is this? Out of nowhere. You struggling a bit. Are you guys looking at anything? Can you see anything that I can't?
Oh, it's dead to my side.
Say that again, Seb.
Said it looks pretty dead, to be honest.
Yeah, it does. Yeah, the main moves were made in London, but we do have a confirmation basically for tomorrow that was still bearish. So when you wake up tomorrow and you look at London, for example, and you see that there is liquidity built up to the upside, what is this telling us?
Trapping buyers. And if it breaks that high, would that not mean it's then the structural shift? So it's got to break it twice.
Yeah, but so pretend that it doesn't break it. Is it more than likely from here it could go higher or lower?
Lower.
Because it's the exact same thing that happened here.
Mm-hmm.
But just on a smaller time frame. So my point of that is always remember the structural expectation and pay attention in which way the liquidity is being trapped. Right? If it's to the upside, why is it trapping buyers in a heavy bearish market? Because it's likely a trap. That's why you don't get caught up in it, because you're aware of the structure expectation. But if we were to do something like this, then what about that?
Just trapping more sellers, but it's still in line with structural expectation.
Yeah. So if it did this, if it did that, what about now? Let me just make it more realistic, yeah? If that happened tomorrow, could we potentially buy?
Yeah.
Yeah? Why?
The liquidity is above. And it's also took out the SMC traders, so where that last candle is.
Yeah.
Obviously, SMC traders are the last ones to be stopped out.
Correct.
Before an entry presents itself.
Yeah.
So if it pushes lower, then goes back up with a real breaker structure, mitigates, you could then potentially target one as like a stop loss from the trend line, target 2 being the SMC above.
Mm-hmm. What do we think of what Connor just said?
On.
But then again, you are going against the structural expectation, so it is a bit risky.
That's correct.
Because it's super bearish.
Yeah. And if we are aware of that fact that we are against the structural expectation, however, the market has opened and only trapped sellers all day. It failed to trap buyers, just trapped sellers, 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 sellers. Then it trapped some buy-side SMTs, gave them a fake reaction, then induced low. There's only liquidity above, right? The market could do that and do whatever it wants to do. But realistically, probability-wise, hey, we are against the structural expectation, but if the market were to do something like that, near this up, right? And price came up here, what do we do? What do we do at this point? We've already entered the market.
Wait.
We've already had a reaction.
You stop loss to break even.
Yeah, and?
Take partials.
Well done, sir, 10 points.
Essentially what you did with that gold trade, isn't it?
Exactly. Why would we put our stop loss at break even and take partials there?
Because who's to know that price, it's done its first break in the opposite direction, but that then could just trap buyers for it to then just break lower and then stop us out because structural expectation is bearish.
Correct. That is correct. That's exactly it. It's that simple. But the only way it's simple is obviously once you've seen it and practiced and repeated it enough times, where you can see it without even thinking about it. This is why in the course we added the 4 stages of how the mind learns. You need to be aware at which stage you're at. Because if you're not aware that those stages even exist, you're going to be confused a lot of the time. You're going to be like, oh, I kind of know it. No, actually, I don't know it. Oh, I'm confused. Well, obviously, if you have to think about it before making a decision, then you're at conscious competence. When you get to unconscious competence, where you don't have to think about it, you just see it, you put the pieces together. It's literally like an automatic sequence that plays out once you've done it enough times. Just like, oh, there's the SMT, yep, oh, there's the fake reaction, there's the FPOS, oh, there's the speed of momentum, time, yep, it's in timing, excellent, reaction, breakout, mitigation, 10-10. That's exactly it, guys. Yeah. So, yeah. I mean, other than actually forcing setups and taking trades just for the sake of it, why in the world would we do that if we can just take more value from doing stuff like this and seeing things in hindsight from a bigger perspective? Because this is where the real value is. Obviously, when you apply it in the markets, you're just applying what you've practiced. That's it. And then there's just a little bit of pressure, emotion, dopamine, whatever, running through your veins. Because it's actually happening. So it's like when you think about professional athletes in any regard. Why are professional athletes so good at what they do?
Because they're consistent.
Consistent? What else?
And they know where they want to be, and they're so aware of what they're good at and what they're not good at.
Correct. And what else? What do they do more of than other people?
Practice.
Practice.
Brain.
Practice, practice, practice. That's the magic word. Practice never ends. Practice never stops. You never stop being a student. The only moment that you stop being a student is when you think you know. And then your teachability index goes down. Because you're no longer coachable because you think you know. Even when you know, you don't know. You only think you do.